Hey friends, glad to have you back. Today, we're diving into something exciting. Investing in India mutual funds through a systematic investment plan with a yearly step-up. This is an excellent strategy to leverage the power of compounding and potentially achieve significant wealth creation over the long term, such as 20 years. Here's a breakdown of how it works and what you can expect. What is a step-up SIP? A regular SIP involves investing a fixed amount at regular intervals. A step-up or top-up SIP allows you to periodically increase your SIP contribution by a certain percentage or a fixed amount. This is particularly beneficial as your income grows, allowing you to invest more and accelerate your wealth accumulation. Benefits of a step-up SIP for 20 years. Accelerated compounding. By increasing your investment amount each year, you're putting more capital to work, leading to a much larger corpus compared to a fixed SIP, especially over a long horizon like 20 years. Inflation hedge. As your income generally rises with inflation, stepping up your SIP helps maintain the real value of your investments and counter the eroding effect of inflation on your purchasing power. Disciplined investing. It instills a disciplined approach to increasing your savings as your financial capacity grows. Goal alignment. It helps you align your investments with increasing financial goals that might become more expensive over time due to inflation. Performance scenario. While actual returns can vary significantly based on market conditions and the specific fund's performance, we can illustrate the potential with a common assumption of a 12 to 15% annual return, which has been historically observed for well-performing equity mutual funds in India over long periods. Let's consider a scenario with an initial monthly SIP of 10,000 and a 10% annual step-up. Over 20 years, assuming a 12% annual rate of return. Initial monthly SIP, 10,000. Annual step-up, 10%. Investment tenure, 20 years. Assumed annual return, 17% for our three-fund portfolio. Example portfolio structure, 60% HDFC Flexi Cap Growth Fund, 30% HDFC Mid Cap Opportunities, Direct Growth, and remaining 10% HDFC Balanced Advantage Growth. You start with a monthly SIP of 10,000 rupees in the first year. Then it goes up to 11,000 in the second year. We need to bump it up by 10% each year, and by the 20th year, it'll hit 61,000 rupees a month. You invest 68 lakh rupees over 20 years, and it can grow to a whopping 3 crore 53 lakh rupees thanks to compounding step-up contribution has significant wealth creation. If you invest just 10,000 rupees in a SIP without any step-up, your total investment of 24 lakhs could grow to a 2 crores. Only. Power of compounding. The impact of compounding becomes exponential in the later years of the investment tenure due to the combined effect of time and increasing investment amounts, review and rebalance. It's crucial to review your mutual fund portfolio periodically to ensure it aligns with your financial goals, risk tolerance, and market conditions. You might need to rebalance your portfolio or switch funds if their performance deviates significantly. Important considerations. Market risks. Mutual fund investments are subject to market risks. The assumed rate of return is not guaranteed, and actual returns may be higher or lower. Inflation. While a step-up SIP helps counter inflation, it's essential to consider the impact of inflation on your financial goals. Expense ratio. Look for funds with lower expense ratios as they can significantly impact your long-term returns. Taxation. Understand the tax implications of mutual fund gains in India. ELSS funds offer tax deductions under Section 80C. By consistently investing through a step-up SIP in well-chosen mutual funds, you can harness the immense potential of the Indian market to achieve your long-term financial aspirations. Thanks for tuning in. Don't forget to like and subscribe. Catch you soon with more fun videos.